welcome to the channel, or maybe welcome back to the channel. I'm Bryce Edwards. Today is November 3rd. We're going to be looking at what happened in October here in the Las Vegas housing market. We also recently got some macroeconomic data. We got the jobs report. We also had the Fed's recent decision regarding interest rates. So we're going to dive into that a little bit more. If you're a buyer, you want to stick around, it might be time to get off the fence in this Q4. If this is your first time watching, you should know that we segment this into 4 sections, actually. So we're going to talk macroeconomic data. We're going to talk about what's going on in the country, which is what we'll get to first. And then we break our market report into 3 sections. It's going to be your general market report, your luxury market report, and then high-rise specifically. I think they're all vastly different from each other. So we break those down, and there will be timestamps below. So if you're only interested in one part of that, jump to that section by all means. So first, let's talk about what's going on in the macroeconomic sense right now. So we recently had the jobs report come out. Jobs report was a little bit soft, which is coincidentally good news when it comes to stocks, 10-year treasuries, and mortgage rates. We're thinking that we're quite possibly at peak rates right now with the Fed. We think they're probably going to hold rates steady, which is what they chose to do this week. So we may be seeing the peak of the market as far as rates, which means that rates are likely going to come down as far as mortgage rates. One of the closest things that we should watch here is the 10-year treasury, as you can see on the screen now, and we are just in a free fall this week. So ever since the Fed chose to pause rates, and now with this jobs report, we are just falling off of a cliff from the peak rates back here. This is when rates were just touching over 5%. So as this goes down, this is not directly correlated to mortgage rates, but they closely follow each other. So let's quickly take a look here, and we are going to pull up the mortgage rates. So let me get this set up for you. So now looking at the 30-year mortgage rate, this number hasn't been updated for today. It's going to drop a lot more, I think, just today. This is future Bryce real quick. I just wanted to mention while I was editing this video, I'll put this up on the screen. Mortgage rates on Mortgage News Daily have now shown 7.36%. So we've seen nearly 0.75% drop off just over the last 2 weeks. So mortgage rates are plummeting. It's going to bring a lot of buyers back into the market. It's one of those things I think you want to be trying to get ahead of. If you've been thinking about moving and you think that these rates are going to continue to drop, you might want to be under contract sooner than later when there might be more competition from some of these other buyers as well. We may be setting up to have a very exciting Q4. This might be a little bit of a knee-jerk reaction too. Only time will tell, but based on where you think the economy might be going, it may be a great time to buy. If you watched my last video, I've been talking a lot about new home sales. They have some great deals right now, some great incentives. They really want to get some Q4 stuff off the books. If you can close before the end of the year, there are some great deals to be had, especially in new homes right now. But you can see just over the past week, we've bounced off that 8% and we are just dropping like crazy. So as of the time of this recording, it was 7.51% on Mortgage News Daily. I think when it updates, maybe we'll be closer to 7.3, 7.2, something like that. So if you're a buyer, it might be time to get back in the market because rates are going to keep going down, and when that happens, there's going to be more and more competition happening. So now that we've talked a little bit about the macroeconomic data, let's jump into what's going on in Las Vegas, and then we'll talk about that a little bit more and see what we can learn from it. So the first thing we're going to jump into here is this is stuff you will not see online. So this is the actual market data pulled directly from the MLS, pulled this on November 1st. So this is what only we can see as agents, and what this is showing you right here as you look on the computer, this is what has been going on in the past 7 days specifically in each of these markets. We're starting right here on the high-rise market first. So as you can see, we're starting to outpace a little bit new listings compared to under contracts and under contract no-shows. So if you look at this, 26 new listings, and we had 8 and 10 go under contract. So that's the sentiment I've seen, and I think that will be what we see throughout this report based on the data I've compiled, is we're slowing down a little bit in terms of buyer activity, but with these new interest rates, it might be changing. But once again, you need to know what has happened in the market to know where we're going. So as we can see, the other thing I would mention, this one doesn't show it as much, but another theme I think we will see is I've seen a lot of back on markets. I've seen a lot of properties fall out of contract, and I think that's likely also due to those 8% rates that we were at. So as we go to the next one, this is just your general residential one. Same thing. So as we look here, 725 new listings, but as you can see, we absorbed 450 plus, so what, 675? So we're not quite there as far as absorbing everything that's come on the market. So we're still outpacing inventory or outpacing under contracts a little bit. So inventory slowly climbing, not anything drastic. We'll talk a little bit more about it later. But as you can see, we're still getting plenty of places sold. The expireds, I wouldn't get too disturbed about that. It's just a thing that happens at the beginning of each month. A lot of times contracts just end around that time. So this one is specifically the luxury market. And how I define luxury is just anything over $1 million here in Las Vegas. So even a more stark contrast to what's going on here. So a lot of new listings, but I should mention, if you've watched some of my other videos, a lot of times a new listing is somebody just withdraws it from the market and puts it right back on just to game the numbers a little bit. It makes it look like a new listing if you're on Zillow or Realtor.com, but it's not really a new listing. It's just somebody relisted it to hopefully get some more eyeballs on it. But nevertheless, as you can see, 61 new listings here, and then we have 9 back on the market, so not as drastic as we talked about earlier. You see a lot more price decreases here, which is good news. And then lastly, so we only had 28 go under contract and 29 sold, but then you look at 61 new listings. So not quite an even market in those terms right now. Okay, so let's jump right into the data. We're going to start with the high-rise market. We're going to look at this snapshot of the last 5 years of activity. We're going to be looking at the trends. Right here, we're looking at the number of sales. So as you can see, there's been some knee-jerk reaction to rates in certain points along this process. So last month was no exception to that. We saw sales fall off of a cliff once these interest rates reached over 8%. So we'll have to keep an eye on that. Nothing like we saw in 2020, but something to be aware of. As we go to our next chart here, we are looking at just a sales price average. So even though we had sales fall off of a cliff, we had sales price average go up just a little bit, staying on the higher end. I guess if you draw a line here, we're maybe about even to a little bit of an increase there. And I should mention with the high rises, I did not market segment it depending on the prices. So you can have sales that happen, 3 to 4 to 5 million, and it can really change these numbers a lot. I think that's why you see so much volatility in here. Lastly, this is just months of inventory, so ignore this big scary spike, which was 2020. As you can see, we are fairly low. I would consider this probably a balanced market as far as high rises go. You want to see 4 to 7 months is considered a balanced market. Anything more than that, you are in a buyer's market. So we're about balanced right now. Next, we're just looking at days on market. I think this is always a great one to keep an eye on. It tells you how quickly listings are selling that are being put on the market. So in this example here, we're staying about even with this number of just over 60. There's a lot of variance in this because certain buildings just take so long to sell, whereas other ones like Signature MGM, they can sometimes take just days to sell. Or like Panorama Towers, there's certain ones that only sell in a number of days. Lastly, we are just looking at the active number of listings across all the high rises. So you can still see we're a little bit on the lower end. This will be an interesting one to keep an eye on when we're looking at seasonality, if any of these get pulled off the market during the holidays. But as of right now, we're fairly steady with about 400 on the market. So nothing crazy like we saw back here in 2020. And we're also not too low either. So with the general market, we're going to be looking at it 2 different ways actually. So I've got the 5-year snapshot like we just looked at with the high rises. I've additionally just got a year-to-date one. So first we're going to start with the 5-year here, as you can see on the computer. So we are just looking at the active number of listings. So we're not quite as low as we were when interest rates were 3 and 5%, and you can also see some seasonality in here as well. But so we're not quite as low, but we're still fairly low. As you can see, before COVID, this is what was considered maybe more of a normal number. But we're on the lower end and we're fairly flat for the year. Okay, so now we are looking at the days on market. So what we're seeing right here is, a home is only taking 30 to 35 days to sell in this current market. So that bodes well for a lot of homeowners. If you have a home appropriately priced, you're able to sell it fairly quickly. I would say 30 days is pretty good in this current market where interest rates have been at, you would have thought this would have been a lot more drastic if you would have been looking at the headlines that a lot of these news stations put out. So now we're looking at months of inventory, and what we want to see here is a balanced market is between 4 to about 7 months of inventory. And as you can see, we are just over 3 months of inventory. There's not a lot of inventory, but there's also not a ton of buyers right now with these higher rates. So what we're seeing here is more of a seller's market technically, but it seems fairly well balanced just because there's not a lot of buyers out there. The next one we are looking at is just a sales price average. So as you can see over these last 5 years, we have been steadily climbing. We've had a little bit of volatility here when it comes to interest rates changes and stuff along those lines, and COVID, of course. But we've been trending up. We've seen a little bit of a decline, and I think we are about 7% down from our peaks. And the last 5-year chart we're going to look at is just a number of sales. Once again, this is a 5-year chart here. So as you can see, we have been dropping off. So every time these interest rates go up, we've seen people come out of the market to see what the interest rates will do. We are seeing that again. We're also probably catching a little bit of seasonality. October, November, December, some of the slowest months when it comes to home sales, but it's also a great time to be a buyer because that's when some of the best deals happen. Okay, so now we are just going to be looking at those 12-month charts I mentioned before, so just the past 12 months. Once again, we are in the single family part of the segment. So past 12 months, sales price average, as you can see, we're fairly flat, maybe a little bit down, but in general, we're still sitting around that 450 to 460 mark for Clark County. Months of inventory, so we talked about this a little bit more. You can see back here, we were sitting a little bit higher, but really we are sitting in a seller's inventory part of the market as far as the past 12 months go, and we've been fairly flat. There's been not a lot of sellers coming on the market, and there's been not a lot of buyers in the market, so we've been generally absorbing about the same amount we've been putting on the market, except for some of those data points that we looked at earlier. Days on market, so this is just a good barometer of how quickly things are selling. As we mentioned earlier, this is following that 5-year trend, so we're just seeing this has been coming down because a good listing coming on the market is still selling within 30 days, which I think is a good number to be at. Here we're looking at the past 12 months of just the active number of listings. So you can see we have been going down as the year has gone on with interest rates going up and up and up. So a lot of sellers are just choosing not to sell because if they sell, it's going to be more expensive for them to buy something else, but it seems like that might be changing soon. So fairly flat over the last 5 months, 6 months or so, but we've been trending down. So now we're just going to look at the sales by month over the past 12 months. So maybe you see a little bit of that end of the seasonality here because you've got to think when a home goes under contract, it still takes 30 to 60 days to close. So some of this data is a little bit delayed based on when it actually went under contract. So as you can see, sales by month still fairly good. I mean, we're looking at over 2,000 for most of these, excluding maybe April here, which I believe is when rates really started to get aggressive. And then we've seen this taper off as rates have now started touching 8%, but it looks like that's not going to continue. So now for our final segment, we are just going to be taking a look at the luxury market. We're going to be specifically looking at what it looks like of a 5-year snapshot of this. So as you can see here, we're first going to look at just a number of sales. So you can see if you zoom in here, let me see if I can get this a little bit closer. So you can see we've had a fairly sharp fall off when it comes to the last couple of months. So that's mainly interest rate dependent. That's maybe a little bit of seasonality coming into play. You can see some of the seasonality trends back here, even though it is a little bit of a delayed indicator, but you can see some of that back here as well. But I would say in general, we've seen a little bit of a slowdown, and in the luxury segment in particular, I've personally seen a lot of homes come back on the market that were previously under contract. Here we're looking at the sales price average. If you followed my other videos, I don't dwell on this one too much because as our homes have appreciated over time, there's just inevitably going to be more homes in the $1 million plus price bracket. So it should never get out of hand because there's always just going to be homes being added into that price bracket as we appreciate here in Las Vegas. So here we're just looking at months of inventory, and this one we're really still sitting at a balanced market. You see we're sitting at maybe 6 to 7 months. Once you get over 8, you would consider that a buyer's market, but it's fairly even right now. A great home is still going under contract. There was one that went under contract last month for $25 million. I think it only took like 10, 14 days, something like that. So There's still a lot of money out there that's moving around, especially coming from places like California. Our next chart here will just be the days on market average. This is always a good barometer of how quickly things are going. You can once again see here a little bit of a fall off. A lot of these people that shop in this price bracket, they might be more rate sensitive due to their businesses. So whereas the normal consumer is rate sensitive just due to the monthly payment, this might be more industry related. So you can still see this because a lot of our deals do happen in cash, but you can still see this happen when there's a little bit of uncertainty, especially when we didn't know what the Fed was going to keep doing going forward. And then our last one is just going to be the active number of listings. So you can see this spike happen when we started getting these interest rate hikes and when we started reaching, 8% and stuff like that over here. So as you can see, it stayed fairly well balanced though for the past 6-8 months or so. So it stayed fairly significantly flat. You see a little bit of a flare up here that's just due to less transactions happening and pulling less homes off the market. And we might see a little bit more seasonality going into the holidays as well. So what can we take from this? What can we do going forward to protect ourselves? And depending on your level of risk, how can you act on this information? So I would say it's definitely been seen across all of these markets. I would say especially the high-rise market the most, that the 8% rate is just too risky for a lot of buyers to get into the market. That was clearly just a line that people were not willing to cross when it comes to financing a place. Now that we've seen these rates start to tumble, I think a lot of buyers will be coming into the market. I think if you're looking in new homes, if that's something that you're interested in, especially a standing inventory home, and you can close before the end of the year, I think it's very desirable right now, and I think it's a great way to go. Make sure to check out my last video on that before this regarding what's going on in the new homes right now. I think we're still seeing a very strong luxury market. As I mentioned in the luxury segment earlier, we just saw that $25 million listing in Spanish Trails go under contract just last month. So as that goes to close, that could end up being one of our biggest sales ever to happen in Las Vegas, other than land sales and the Summit. But I would say, depending on your financial outlook, depending on what your risk tolerance is, depending on what you think the market's going to do in the next 5 to 10 years, I think you should always be buying with 5 to 10 years in mind. That way you can weather any sort of volatility in the market. But I think we're going to see mortgage rates continue to fall as long as these numbers are where they are. I think the Fed is probably staying put about where they are, which is putting this 10-year treasury cratering down, as well as mortgage rates currently. So if you're thinking of buying a house here in Las Vegas, or maybe if you're a seller and you see this as an opportunity to get out of a home you bought during COVID and you've hated that home the whole time, but now you have the opportunity to switch, reach out to me below. I've got a meeting link below. We can do a Zoom like this, or we can just jump on a call. That's usually the best way to reach me. My website is down there below, and I've also got my phone number down there. So you're not going to be texting just some random person. It goes directly to me. So if you're thinking about making a move, let us know. If you're thinking about moving from out of state, we help facilitate that for you. We take a lot of the stress off of your plate, because in a situation like that, it really comes down to communication and understanding the whole entire process. So with that being said, I would really appreciate it if you could subscribe to this channel. It helps me out a lot. If you could drop a like on this video as well, and just give me your take in the comment section. Let me know what you think is going to happen over the next 6 to 12 months. I personally think we'll see mortgage rates continue to fall. I wouldn't be surprised to see us 7% at this rate by the end of the year. Once again, thank you for watching. I've got to head out to some appointments, so I appreciate you guys watching, and I will catch you in the next one.